as a public bank, if it's a risky loan, doesn't that mean that the public bank could lose money, our state deposits?
It does. And so here's how that works so that you can reduce the risk. We're not talking about going and gambling. We're talking about an entrepreneur. Let's use the new business example. An entrepreneur who has a very good idea, and there's a known market for that, for what they want to produce. And so the private bank would not want to take a chance, but the public bank is in the business of trying to encourage, and this is one other big distinction between a public and a private bank, and that is the public bank's mission is to encourage economic development in local communities. And so the public bank is geared to help that kind of borrower, and it sets aside a certain percentage of the money that it loans out to a higher risk loan, what we call administrative loans. And those are calculated as having a higher default rate in the bank's planning, so that they know that some of those aren't going to work out. And I'll give you an example of a loan program in North Dakota that works very well. And there is a slightly higher rate of default, but it's not much. And that is, they will loan $25,000 through the community bank on a signature loan. That is, there's no collateral. And the $25,000 is for the entrepreneur to put together a thorough business plan. And the entrepreneur owes that money, but it's a high risk loan because it's only backed by their signature. If the business plan is a good plan, then the public bank will go up to $500,000 in helping that entrepreneur get their business going on a startup basis. And then if that's working, there can be more loans. But if you look at it, $500,000 plus $25,000 is what's at risk. And if you're as with the Bank of North Dakota, you're loaning out $4 to $5 billion a year, or actually that's not per year. They have about $6 billion out, but you're loaning out probably over $1 billion a year. $525,000 is a small amount to be at risk. Moreover, the track record is that very few of those $525,000 loans go bad.
Because the bank encouraged them to do a really good job in their planning.
Yeah.
Gave them the money to be able to get experts to help.